Spot versus futures trading in crypto is one of the most important topics every trader needs to understand because it determines how you approach the market, how much risk you expose yourself to, and how you plan your long-term strategy in the world of digital assets. Spot trading is the simplest type of crypto trading where you buy and own the actual cryptocurrency, meaning when you buy Bitcoin or Ethereum or Solana on the spot market, it becomes yours and you hold it in your wallet. Futures trading, on the other hand, involves contracts, leverage, and speculation where you are not buying the asset itself, but a contract that predicts what the price will be in the future. Many new traders jump straight into futures trading because of the promise of higher profits through leverage, but the truth is that futures trading carries significantly more risk, liquidation danger, and emotional pressure compared to spot trading. Understanding the difference between these two styles of trading helps you make smarter decisions and avoid unnecessary losses. When trading on the spot market, everything is straightforward. If Bitcoin is $40,000 and you buy one Bitcoin, you now own one Bitcoin. If the price goes up, your asset grows in value. If the price goes down, your asset drops in value, but you still own the crypto. There is no liquidation, no expiration date, no funding fees, and no complex contract mechanisms. Spot trading is also the foundation of long-term investing, especially for those who believe in crypto fundamentals, blockchain technology, decentralization, and the future of digital finance. People who buy crypto for long-term holding rely heavily on spot trading because it allows them to slowly accumulate assets, practice dollar-cost averaging, and build strong positions in assets like Bitcoin, Ethereum, Cardano, XRP, and other high-potential altcoins. Spot trading is seen as the safest entry point for beginners because there is no leverage risk, no margin calls, and no sudden liquidation events that can wipe out your capital. Futures trading operates differently because it does not involve owning the actual cryptocurrency. Instead, you trade price speculation contracts. The most popular type is perpetual futures, which do not have an expiration date. Here, traders use leverage to control a larger position than their actual balance would normally allow. This is where crypto leverage trading becomes both exciting and dangerous. With 10x, 20x, or even 100x leverage available on exchanges like Binance Futures, Bybit, OKX, KuCoin Futures, and BitGet, traders can turn small price movements into large profits or devastating losses. Leverage magnifies everything, and liquidation becomes a major risk. If the market moves against your position even slightly, you can lose the entire margin you used to open the trade. Many people lose money in crypto futures because they treat it like gambling, enter without risk management, ignore technical analysis, or underestimate crypto volatility. Spot and futures trading differ not only in ownership, but in purpose and psychology. Spot traders usually think long-term. They focus on market structure, accumulation zones, having cycles, macro trends, and blockchain fundamentals. They are patient and can afford to wait for the market to recover even if prices fall because the assets remain in their possession. Futures traders, however, operate in a much more intense environment. Their decisions must be fast, calculated, and backed by strong technical knowledge. Futures trading is often used by advanced traders who understand chart patterns, market trends, liquidity zones, funding rates, open interest, and the mechanics of order books. Futures traders can profit from both directions, longing when prices rise and shorting when prices fall, which makes the futures market attractive during bear markets when spot traders are suffering losses. But the psychological pressure of futures trading is much higher because every move in the market affects your margin. One of the biggest differences between spot and futures trading is liquidation. In spot trading, you cannot be liquidated. Even if the price drops 80%, your crypto is still yours, and you can choose to sell or hold. In futures, if your assets fall below a certain threshold, your position is forcibly closed by the exchange to prevent further losses. This liquidation level gets even closer when you use higher leverage. A 1% movement can liquidate a 100x leverage position. A 5% movement can liquidate a 20x position. Meanwhile, someone holding the same asset on spot suffers nothing more than a temporary loss in market value. This is why understanding liquidation risk is essential before entering the futures market, because futures trading is one of the fastest ways to lose money for those who are unprepared. Another key difference is funding fees. In spot trading, you don't pay anything after buying the asset except for normal trading fees. Futures trading, especially perpetual futures, requires traders to pay or receive funding fees every few hours based on market bias. When funding is positive, long traders pay short traders. When funding is negative, short traders pay longs. Funding fees influence strategies in futures trading because they can eat into profits or create arbitrage opportunities. Spot traders do not deal with any of these complexities, making spot trading a more beginner-friendly and stress-free environment. Market volatility affects spot and futures traders differently. In the spot market, volatility creates opportunities for long-term accumulation or swing trading. If Bitcoin drops, spot traders may see it as a discount. Futures traders, however, face enormous volatility risks. A sudden price spike can liquidate a short position, while a sudden drop can liquidate a long position. Because crypto is highly volatile, futures traders must be extremely careful, disciplined, and strategic. Understanding crypto price prediction, technical indicators, candlestick patterns, and market momentum becomes crucial. Futures trading demands more skill because every small move has amplified consequences when leverage is used. Another difference between spot and futures is the trading strategy each market attracts. Spot traders often use strategies like buy and hold, dollar cost averaging, swing trading, or accumulation phases. Futures traders rely heavily on short-term strategies like scalping, day trading, breakout trading, liquidity grabs, trend continuation setups, and market reversal trades. Futures trading requires precision and timing because even a slightly wrong entry can lead to large losses. Spot trading is more forgiving, allowing traders to stay calm even when the market becomes unpredictable. Spot trading is also popular among beginners because it allows them to explore the crypto ecosystem, staking, DeFi, farming, NFTs, token launches, and decentralized exchanges. Many income opportunities exist only for spot holders, such as staking Ethereum, delegating Cardano, earning yield on Polygon, participating in airdrops, or using tokens in decentralized finance. Futures traders do not get access to these benefits because they do not hold the real assets. Their focus remains solely on price movements and leverage-based gains. Understanding liquidity and market depth is also important. Futures markets often have deeper liquidity because institutions, market makers, and professional traders operate heavily in derivatives. This deeper liquidity can create smoother price movements in large futures exchanges. However, the futures market is also where manipulation is more common. Whales sometimes push the price into liquidation zones to wipe out over-leveraged traders. This is known as liquidation hunting, and it happens frequently. Spot traders are not affected by liquidation hunts because their assets cannot be forcibly closed. Futures traders must always consider liquidity zones, high leverage clusters, and whale movements because their entire trade depends on survival against volatility. Spot traders also have full ownership of their assets, allowing them to store cryptocurrency in cold wallets, hardware wallets, or decentralized wallets. Futures traders keep their funds on centralized exchanges, which introduces additional risks like exchange hacks, technical failures, and fund freezes. Ownership plays a major role in long-term investing, and many investors prefer spot trading because it aligns with crypto's original purpose, true financial sovereignty. Futures trading does not offer ownership, only exposure to price movements. Profit potential differs significantly between spot and futures markets. In spot trading, profits are slower but safer. If you invest $1,000 in Bitcoin and it rises 10%, you gain $100. In futures, with 10x leverage, that same 10% move becomes a 100% profit. But the same amplification happens on the losing side. A 10% drop would wipe out a 10x leveraged position, while spot traders simply experience a temporary decline. This difference is why many beginners misuse leverage. They get blinded by the possibility of higher profits, ignoring every risk that comes with it. Risk management is one of the biggest areas where spot and futures differ. Spot trading requires minimal risk management beyond choosing when to buy and sell. Futures trading requires stop-loss settings, position sizing, leverage control, margin monitoring, and strict discipline. Emotional trading destroys many futures traders because the rapid fluctuations create fear, greed, anxiety, and impulsive decisions. A futures trader must approach the market with a clear plan, knowing exactly where to enter, where to exit, and how much they are willing to risk. Many traders who succeed in spot trading fail when they jump to futures trading because the psychological pressure is multiplied. Another important factor is time commitment. Spot traders can buy crypto and hold it for months or years without needing to monitor charts constantly. Futures traders must pay close attention to the market because their positions can change dramatically in minutes. This makes futures trading unsuitable for those without time, focus, or emotional discipline. Spot trading allows more freedom, while futures trading demands constant attention, chart analysis, and real-time decision-making. Futures trading also has a learning curve involving technical indicators such as RSI, moving averages, MACD, Fibonacci retracement, support and resistance, trend lines, and market order flow. These tools help predict market direction and identify profitable entries in a leveraged environment. Spot traders use these indicators too, but mistakes are not punished as aggressively because there is no liquidation. Futures traders must use technical analysis with precision because one wrong move can end their entire trading account. Overall, spot trading is ideal for beginners, long-term investors, and anyone who wants to grow wealth steadily without extreme risk. Futures trading appeals to advanced traders seeking higher returns, faster profits, and the ability to trade both up and down markets. Each system has benefits and drawbacks, and the correct choice depends on your experience, risk tolerance, and financial goals. But understanding the difference between spot and futures trading ensures that you approach the crypto market with clarity, confidence, and the right mindset to avoid common mistakes. If you want more deep, beginner-friendly explanations like this, don't forget to subscribe, share this video, and tell me in the comments what topic you want me to break down next for you.